Sometimes silence is deafening. For months now in the real estate industry, the news has all been like Chicken Little, projecting crashes and crises and panics and 2008-like adjustments to the marketplace. And well, that's quieted down a bit, and I'm going to tell you why. I'm Bill Gross. I'm the LA Probate expert, and this is my weekly market review. I go through the market and share with you what's happening in the market so you can make the best decision on buying, selling, or not doing anything. So let's take a look at the actual data, and I think it's really important, rather in my opinion, what's the data telling us? Well, one thing we know is a very important factor are interest rates. Let's take a look at the interest rates. Very important. You didn't hear this in the news this week, that the 30-year fixed rate closed just below 6% at 5.97. Now, this isn't just some lenders' rates or one lender's rates. This is the actual market rate. Just like stocks, there's one correct price for Apple at any split second in time. It changes when the market's open. There's the same true for Fannie Mae and Freddie Mac mortgage rates and the jumbo rates as well as a market rate. It doesn't get reported accurately. I'm going to show you the differences, but it's important that since the beginning of September, while rates did go above 6.2% twice, they've settled back down. And if you look at the rates over a longer period, let's see for the year, they've gone up and they look like they're going up. It seems as though now, for the second time, we've hit this plateau and not moving above 6%. I'm not projecting anything or predicting. I'm just saying based on the data right now, we haven't got there. Now, one reason why the news is so bad when they report it is that I talked in the past about the Fannie Mae survey, that rather than reporting the actual market rate, they get surveys from their members. Some report, some don't. Some are accurate, some aren't. So let's take a look at the survey rate, the orange, against the blue, the actual market, because we have real data, and you can see two things. One is the survey rate is always lower than the market rate, except for it gets caught completely off guard. It's always lower, which means they're biasing to the low side, they're lying to the low side, it's inaccurate to the low side. I'll let you judge that. But also you see that it trails in direction. When the blue pops up, the orange later comes up and follows it. When the blue goes down, the orange trails and goes down. When the blue pops back up again, the orange trails down and then goes back up again. So the survey is highly inaccurate on a week-to-week basis, and overall is less accurate than the actual market, of course. But what we're going to see here is that the survey has been showing constant increases, and in reality, what's happened is we hit a peak, it's over 6.25, and have come down. So it's important to note the rates are much less volatile than they would be. Certainly, with a historic rise from 2.5 to 6.25. That's one of the fastest, highest rises ever. But since then, it seems to have stabilized. Based on the data so far, it's stabilized in that range. Now, what does that mean as far as interest? What does it mean as far as the real estate market? Well, it's hard to say, but what we do know is in order for there to be a crash, there has to be more sellers looking to sell than buyers looking to buy, and that's clearly not the case either. Take a look at the inventory numbers continuing to drop. Now, a few weeks ago, the industry was breathlessly reporting that inventory was rising. Well, it did rise above last year's pandemic all-time historic low rate. But look what's happened since now. It started to turn back down again. It actually is almost the same as last year's numbers and is well below 2 years ago, the beginning of the pandemic numbers, and is well below pre-pandemic. In fact, it's about half of what it was pre-pandemic. Now, I believe there's some structural reasons why there's less inventory. Like everything in America, there's less inventory because of supply chain issues and other factors. But what's also true is inventory is going down, not up. And so this is going to tell us we're not going to have a housing crash unless we have sellers desperate to sell to cause the crash and monetize the crash to go down. So that's not happening. Then a couple weeks ago we had reports about escrows canceling. And it's true that more escrows canceled for the last few weeks than a year ago. Even Zillow, though, reported accurately that while these more pending numbers, more escrows are canceling. Even they reported that it was less by percentage than pre-pandemic levels. And so what that tells us is, you can see the paragraph, the share of contract cancellations, pending listings have gone back to the market on sale, has recently increased, but remains in line with pre-pandemic norms. It's actually below pre-pandemic norms. So another way of saying this statistic really is not all that significant given our current market conditions. Now, where's the market going to go? Well, nobody really has a crystal ball. And oftentimes people project, rates are going to go to 8, 9, 12%. We're going to have hyperinflation. Those are projections. And oftentimes not by people being held accountable. But one group that is, a quasi-government agency, Fannie Mae and Freddie Mac, do make their projections and publish them. And you can see here, Fannie Mae's projections are that next year rates will go down to 4.5%. That's a big drop. I mean, if that's true, that's a significant. Now, this is not just them saying, MSNBC reporting it. This is at Fannie Mae, their actual forecast, 30-year fixed rate. And you can see they forecast this year 5.1. We're now at 5.9, a little higher than that. So we'll see how accurate or inaccurate they are. And to stay high in this quarter, the end of the year to go down. We started that direction. And next year go down as low as 4.4% in 2023 overall. So we're looking at a significant drop in interest rates based on the quasi-government agency. Now again, it's a government agency, so maybe there's some politics behind it, a reason why in an election year. But what's true is it doesn't appear, based on data, the rates are catapulting out of control in a hyperinflationary mode. There were a lot of reasons why the market, the war in Iraq, the war in Ukraine, turning the rate has a factor on it, but overall the economy has not spun out of control as many people projected. So what does that mean for you? Well, as I always say, the best time to buy a house is when's the best time for you to buy a house. The best time to sell a house is when's the best time for you to sell a house. And so what I would say to you is, don't get caught up in the industry news. Make a decision with all the information that affects you. What's the real market factors? What's the real rates? Can you afford it or not? If you can, let's get you the best execution possible. If I can help, call, text, or email. I'm Bill Gross, the LA Probate Expert. And as always, make today your best day ever. Thanks so much.